According to Instinet, we have not had a 1% down move on the S&P for more than 2 months. We like it. We like to see our numbers and our accounts go up. But is it starting to feel a little frothy?
Well, maybe I should just say, wait for it, Brian. It may not come in the whole market. And I think what we're seeing already this year, and certainly through last year, is and increasingly a lot of divergence in where particular stocks go, right? Some stocks clearly have pretty frothy valuations. Some that did very well last year are probably pretty large proportion of client accounts. We're getting a lot of questions from our clients on what to do with some of the positions, they might have held in a separate accounts. And when they ask us to come along and help them work out of those positions, what we hear is a lot of concern about those risks, global risks, inflation risks, and those positions being a very large share of portfolios, whether it's a Tesla or an Amazon, they need to work out of those. So in terms of those higher valuation stocks, with interest rates likely to rise, it's time to really move on and get more diversified.
Well, it might be taxes too. You might have just heard our conversation, JoAnne, with Robert Frank. So if one of your clients has owned Apple for 5 or 10 or whatever years, or Amazon, whatever, they made a lot of money on paper, you're looking at the possibility of higher capital gains rates. Are you advising them to sell some of those winners, take the lower cap gains hit now, because if they think it's going to go up, right, sell it now and buy something else?
Yeah, it really depends ultimately what they want to do in the long term with their portfolio. If they've been with us for a long time, right, we've been on top of that. We've been working them out of larger positions and keeping them diversified. But if you've got a new client who comes in with a big position, that's one thing we offer is a tax management program to work them out of those positions. And it's clearly a concern if people think that the capital gains tax is going to go up, and as the probability perhaps rises that it will, I think we are going to see folks work out of those positions. But on the other hand, there's that as a headwind, but as a tailwind, a company like Apple, a company like Microsoft, these are going to be good growers in the long run after we get through this temporary disruption. So I wouldn't be rushing out of these positions that have good long-term growth potential, like we think there still is in an Apple or Microsoft or a Palo Alto, given what just happened to the pipeline over the weekend. So there's a lot of good opportunities for growth out there, and you have to balance maybe working out of some high, percentage positions, but not getting away from growth, which we still think has a lot of drivers. Cybersecurity being one of them. We like Palo Alto. We've owned it for a long time. But also 5G that I've talked about a few times before.
Shepard Smith here. Thanks for watching CNBC on YouTube.